Welcome back to The Pop, a podcast about America's capital markets and IPO machine. Today's guest is Omid Malekan, a professor at Columbia Business School and the author of Re-Architecting Trust and The Story of the Blockchain. You are a crypto professor.
Yes.
Well equipped to talk about the intersection of America's capital markets and where technology is going to take it. So thank you for joining us today.
Thank you for having me. It's actually one of my favorite topics to talk about.
Well, that's why you're here. So I'd like to talk about in general today, how capital markets work and how blockchain technology is going to intersect with them, how it's already intersecting with them, and how you think it's going to change them going forward. I know it's a big topic.
Yeah.
This is going to be likely the last conversation of the season and something to end on thinking about the future. And so, first off, what do you think the most transformative opportunity is to take what we currently do and put it on a blockchain? I know it's a big question.
Yeah. So I think, as I know and you've probably covered in the other episodes, people tend to underrate how much the existing design or architecture of the capital markets is a consequence of technological or operational limitations of the past, right? Like the basic idea that the stock market doesn't close at 4 p.m. so traders could make happy hour. That is specifically an infrastructure issue, as are many other things, including the actual products that we have, equities, derivatives, debt, et cetera. So to me, blockchain is a technology that eliminates almost all the frictions and creates almost like a blank whiteboard of what is now possible for capital markets. And that's why it's so exciting.
Yep. So some of the limitations, you talked about closing at 4 p.m. What are the other limitations and flaws that, you think are the low-hanging fruit, over time for us to address?
The fact that most markets are single asset. So we have an equity market, we have a debt market, we have an options market, we have foreign exchange markets. But now that it's all virtual digital assets, they're all just database entries. And I think one of the best aspects of tokenizing and moving on a blockchain is a term I made up. It's omni-asset. Right? All assets could exist on the same exact infrastructure, which is great from a safety and soundness perspective. So actually like two things that have been the goal of capital and currency markets forever, which is true, what we call atomic swaps, what TradFi folks call delivery versus payment or payment versus payment. So that's very exciting. The fact that you can have the derivative exist on the same exact infrastructure as the spot, again, great for safety and soundness. Programmability via smart contracts. And then lastly, just really expanding the potential set of direct market participants. So who can invest in what without having to go through an intermediary?
Yeah. I love this concept of the omni-asset platform. So in order to get there, right, we have to figure out a way as a society to do this for each asset, right? Where, for equities, we have an equity market structure. We have the, depositories, we have the broker-dealers, we have the exchanges. They all have to somehow play by new rules. For fixed income, it's a different set of participants, right? For currency, trading, it's a different set of participants. Do you think it all happens all at once? Or do you think, this is going to, happen in bits and pieces where certain assets will move first, and then eventually we'll just get to some standardization of new rails?
I think for the foreseeable future, we're in the hybrid stage where everything we do with tokenization has to be a hybrid, a combination of the old ways and what's now possible and desirable. And it's definitely going to come in bits and pieces, fits and starts. It's actually been fascinating watching what has been successfully tokenized and what hasn't. I think myself and a lot of other people, if you asked us like 7-8 years ago, it's like, all right, 2026. What are the things that are the most tokenized on chain?
What do you think the success stories are so far?
Obviously, stablecoins is number one. Then proxies for U.S. Treasuries are number two.
Proxies, not actual U.S. Treasuries.
Not actual. I look forward to the day that the U.S. I've pitched this to the U.S. Treasury Department that they should think about the day where they just literally issue a token on some chain.
I agree. I would love to see the U.S. government doing primary issuance on chain.
Because it's not just because it's good for the Treasury, it expands the reach and investment market, but given that treasuries are so foundational in so many different markets, the fact that you could have them exist on the same exact infrastructure where you have a stablecoin. So now you have a smart contract controlled tokenized repo market, which would be great. And then like people who want to do treasury basis trades could do it on the same exact network, and that would be great. So treasuries, and then next, it seems like different kinds of equities of some mix of public and private companies, which I have to say is quite ironic because many years ago, myself and other people argued that, tokenization, that's going to be primarily used to bring liquidity to illiquid assets, right? So remember we were talking about, people did tokenize real estate.
We started with these exotic little niche things, hoping that by turning it into a token, it would suddenly become liquid.
Exactly. And now we have years of data, and what we see is actually the things that there was demand for to be tokenized are the most liquid things on earth, like the US dollar and treasury. But the demand was to expand access and to be able to do different things with them. So for now, my mental model is we're sort of going to continue down this path. And I think things like public equities and maybe high-value private equities, clearly demand all over the world. Clearly lots of people who can't just open a U.S. domestic brokerage account and get access to them. And then we'll see with what else comes next.
We'll see.
Yeah.
But I agree with you. I mean, we have seen some experiments from private companies, through one or two different models that I don't know if they're going to be the long-term approach to it. We've seen a couple different approaches with public equities, a lot of experimentation here. It's still early.
It's very early.
Yeah.
In fact, we hardly have anything. And I think it's important for people like me and everybody else in the crypto industry to remind ourselves that we shouldn't over-interpret what the state of the tokenized world is today. It's also possible that like tokenized real estate does one day come back and become a huge thing. It's just that the order of operations had to be different.
Yeah. I think maybe we'll also see some intermediary steps, right? So like we don't have primary issuance of treasuries on chain yet, but we have these fungible liquid proxies, right? It's possible that we wind up with REITs that are popular before we have individual houses or mortgages as well.
Yeah, and the thing that really excites me as someone who's more on the academic side of things is there's so much that we don't know what's going to work and we can't know without trying. So that fundamental question of if people want to invest in real estate more broadly, so they do it in tokenized form, is there actually going to be a lot of demand for individual properties? Or would people rather invest in tokenized forms of REITs because there's diversification, right? Like, how do you have real-time price discovery on an individual building on any given day? I don't know. But a lot of this we can only speculate, pun intended. People have to try, which is why even those experiments years ago, I remember I talked to these European founders who created a company that was tokenizing individual houses in the Detroit area. And I was like, why in the Detroit area?
I think I might have bought one small share of one of those houses in
Yeah.
Detroit like years ago.
And the guy's like, well, houses in Detroit are really cheap.
Yeah.
so because we need to buy them first before we tokenize them. And in retrospect, we can laugh about this, but it was important that they tried that for all of us to learn, like, okay, right now, that's not the thing that there's demand for. And then move on to other things like stablecoins.
Yeah. I mean, my hypothesis would be, stablecoins are the biggest and first because there is no pricing difficulty, right? We know that generally it's $1. There is no...
That's a great point.
Yeah, there's no complexity. And it's also extraordinarily fungible, right?
Yeah.
Like you can have 100 billion of it that all behaves the exact same. The exact opposite end of the spectrum is that like individual house in Detroit, which is worth like $15,000 and it doesn't price very often. And it's like a small ticket that like you can't aggregate demand into.
I love that point about that there is no price discovery if the stablecoin works and the fungibility. In retrospect, the other thing that makes sense is it makes sense if we're going to build this completely new and different tokenized financial infrastructure. It makes sense that the unit of account or the numeraire that things trade against will be the first thing that becomes sort of ubiquitous, because it's once you have a tokenized dollar, it's that much easier to then have a tokenized market for equities and debt and derivatives and other things. Even U.S. Treasuries, like they need to pay interest,
Yep.
and you need a stablecoin to do that.
Well, let's focus on the asset that's sort of in the middle of this evolution, which, has been a topic of the season. It's a topic that Superstate is focused on, which is equities, right? The public market for companies and when they go public and how they raise capital, et cetera. So far, all of the tokenization that we've really seen within equities is on a secondary basis. It's after a company has already gone public, there's already liquid and robust secondary markets on, primary exchanges, those tokens becoming available, outside the US primarily, also potentially in the US. But we're seeing it for secondary markets. We're not seeing it for the act of raising capital yet. What do you think it takes for the capital market infrastructure that exists today to intersect with tokenization? What do you think the obstacles are?
There's a couple. One of them is actually maybe not even infrastructure related, which is that for various reasons, some of which are sort of beyond my domain of expertise, going public is now much more of a exit liquidity event than it is a capital raising event. Right? It used to be like you would go public to raise the big money, to do the growth. But we now live in a world where there's soon going to be multiple trillion-dollar companies.
Right. It's series like G to K when you go public, as opposed to like series B.
Right. And part of that is because we happen to be living during a time of abundant private market capital. I don't know if that'll always be the case. I mean, I don't think like venture investing and angel investing is going to go away, but there just happens to be a lot of money in that now. But history tells us you go through periods of abundant capital and scarce capital. Then there's the regulatory question of just post Dodd-Frank and other major regulations. It just became a lot more expensive and cumbersome to be a public company. Going back to being the professor, there's now academic literature research that shows that these had a direct impact with the fact that less companies started going public later. So there's a regulatory issue. It's not a technology problem, but where the crypto tokenization maturation dovetails nicely with it is the fact that because we have new infrastructure and rails now, we're getting new legislation and new regulation, a lot of which is a good opportunity to revisit the old rules. So I think the two things that need to happen, going back to your original question, is one, the actual tokenization infrastructure needs to continue to improve, which we have no reason to doubt that it will. The other thing is the rules and regulations need to become more favorable to younger companies going public without facing a huge cost and a lot of friction and a burden that a lot of executives increasingly don't want to deal with. And it seems like that's also happening.
Yeah, I mean, I would, love to see changes on the legislative side or the regulatory side to enable more of this. I mean, as of the time of this recording, there's, vibrant debate over the Clarity Act in the Senate. The SEC has some like tentative ideas around crypto fundraising exemptions, sort of tokenized fundraising, not for, tokenized securities, but for non-security tokens of some variety.
Mm-hmm.
I've yet to see the details in, at length, but there's definitely opportunities to open things up from a policy perspective.
Yeah, and the good news is that given most of the regulators are principles driven anyway, right? Like the SEC doesn't just have one mandate. It doesn't just have a mandate to regulate. It has a mandate to also aid capital formation. So that being the case, and given how new technology leads to people asking basic questions like, hey, why does the market close at 4 p.m.? Right? Or should it be this hard to go public as a company? Particularly because if the technology continues to reduce the infrastructure limitations, right? Like there's some cost, I actually don't know what it is, but there's some cost of actually issuing shares into the existing capital market stack, having them listed at a major exchange, And then also having liquidity providers and market makers. Like that. If you're going to go public, I'm sure you have to think about all of that. But now it's, well, like you could just issue a token on a blockchain and potentially have it be integrated into DeFi, and potentially even like you can seed your own AMM pools to be the liquidity provider. So technology is eliminating the physical frictions to companies going public with their equity sooner. And if the regulations keep coming along, which it seems like they are, then I think we will see much more companies tapping the public markets to raise capital, and individuals having opportunities to participate sooner in the growth.
Yeah, I would love if we could just fast forward to the moment when like a company can just, create their shares as tokens and they go straight into an AMM.
Yeah.
And it circumvents all of the other intermediaries that make this complicated, expensive, slow, error-prone, and expensive for companies to be public.
Me too. And you could argue from a regulatory perspective, for them to succeed at their job, which is to live up to first principles like protect investors, preserve market integrity, aid capital formation, the version of the capital markets that you just described is a lot more easily regulatable than what we have today. The token's transparent. The smart contract code could be transparent. You can go and literally look at every trade as it happens in real time. Look at what the liquidity situation is. So I look forward to the moment where regulators and the lawmakers who create the rules that regulators follow start to have these light bulb moments and say, actually, if we embrace the new thing, it means that it'll be easier for us to succeed at the goals we care about.
Yeah, absolutely. I mean, I think they're just worried about, moving too fast and too far before everybody else is ready, before the existing incumbents are ready, before, before everybody's sort of like, on the starting line.
That is true. I would say that is also a more generous interpretation of their hesitation.
I'm being generous. That's my role. Yeah.
That's your role. I'll be critical for a second. I think that different kinds of regulatory capture is definitely a headwind, particularly the kind that's not, like corporate executives, Wall Street executives getting together in a back room and be like, muhahaha, we're going to influence the regulators in these ways that protect our moats. It's just systems have a tendency to evolve to a point where they protect themselves and protect the status quo. So if you've been in financial regulation for a long time, you have a network of people in the financial sector who you trust and respect, and you talk to them because you want to know what they're worried about and what they're thinking. And those people, perhaps even subconsciously, are worried about what disintermediation means for their company, for their shareholders, for their careers, for their bonus at the end of the year. So the system is biased towards preserving itself, which means fighting against the more radical kinds of change, which I would like to see, because I just think it's better. But that's why I think it's the responsibility of people like me to make the important first principles arguments as to why the radical change, which I'm not saying we should do tomorrow, but we should be headed in that direction because it just leads to better capital markets.
Yeah, I completely agree with you. I'll take the devil's advocate side just for the fun of a podcast. I think the radical change is the most beneficial, right? Or the radical experimentation is the most beneficial because we don't even know what's going to work, right? Crypto as a proving ground and as a sandbox has been incredible for experimentation so far. A lot of these experiments are conducted historically in unsafe ways, right? I'll just say this as like a DeFi founder who has watched a lot of DeFi projects get built over the years, right? There's been a lot of like Anon 24-year-olds who have like blown things up into smithereens while proving out incredible concepts and incredible points. And I think one of the hesitations from, the incumbent machine, so to speak, is that, experimentation is good, but it just has to wait for it to be done in this sort of like fully vetted, fully approved way. And like nobody wants, at least within TradFi, the people I talk to, nobody wants Anon 24-year-olds to be the ones doing the experimenting. They want, an investment bank to be the one experimenting.
I will devil's advocate your devil's advocate.
Please, yeah, full circle.
It's
yeah.
not like the more regulated, respected, established Wall Street firms don't blow up.
They do.
themselves.
I agree. They're equally unsafe in their own way.
It's just the history is not very favorable there. And I'm not just talking about the major things like the 2008 financial crisis, like even just once a year, something that happens that you shake your head and you're like, wait, I thought all these people are responsible and mature and regulated.
Oh, yeah. I mean, if you read Matt Levine's money stuff,
Right.
It's like every week there's like an embarrassment on Wall Street.
Right. So this is where I think when they argue for the more measured, reasonable approach, they are literally more talking their book. But that doesn't mean that we should not be critical of the crypto industry. I think we should be very critical of the crypto industry because for every honest experiment by an Anon 24-year-old that ended badly, there's probably 9 dishonest attempts to just make a quick buck.
Agreed.
Right, where the disclosure is not there. There are way too many conflicts of interest, insider information, too much inner dealing with related entities. And that is something that I think the outside world, including the TradFi world, is right to be suspicious of this industry of.
Oh, great. Just to be clear, I think the actual legitimate new experiments conducted by Anon 24-year-olds are a societal benefit, right?
Yeah.
They create knowledge for everybody, fail or succeed, right? Sometimes, things have happened where it's like it's not well intended. I think there's a lot of really well intended things that have worked and some that have not worked. But the ones who are actually like experimenting with new ideas and new models and new frameworks and new technologies and new approaches, like that's adding, a net benefit for everybody, even if it gets hacked and it blows up.
I agree. In fact, just literally earlier today, I was having a conversation with a friend, an academic who's been following things for a very long time. We were talking about algorithmic stablecoins and Terra.
Oh, yeah.
And I get why people wanted those to work.
I wanted them to work. They don't work.
They don't work
historically.
But we all wanted them to work. I get why even today, if somebody comes up with some new model of something like that doesn't have the centralization vectors of a fiat-backed stablecoin or the capital cost issues of like a over-collateralized crypto-backed stablecoin, I get why people wanted that. I also get why a lot of people who are more tech folks than finance folks could think that some mechanism like that could work. And now there were things about Terra that were also just fraudulent and dishonest.
There were some very bad behaviors there.
Yes.
Besides the novel experiments.
Exactly. But in a way, I think maybe you would agree with me that it's good that the experiment happened. I think it's unfortunate that it got so big and so many innocent people got hurt due to the collapse. But it's good that we sort of got that out of the system. We said, okay, well, that doesn't work as much as we would like it to. So now let's figure out how to make the other approaches to building a stablecoin as useful as possible, which is the stage I think we're in now.
Yeah, I mean, we got legislation. We got stablecoin legislation that specifically said Terra bad, right? Dollar in a T-bill or a bank, good. Like that's how you create a stablecoin, right? The Genius Act learned directly from those experiments.
Yes, great point. I forgot that that's actually, I've so like.
It's the one thing you're not allowed to do.
Yeah.
Yeah. Genius is built on the back of Terra.
Yeah. Good.
Yeah. So in terms of like going from idea and experiment to like adoption and implementation, like what do you think it takes from an institutional perspective, from a regulatory perspective, from a trust perspective to go from like, hey, this thing worked in crypto to financial markets just saying like, let's start to move in this direction? Because I don't think we've like fully moved in the direction of tokenization yet.
No.
I think there's a lot of incredible proof points, but we haven't really moved there yet. Like, what do you think are the hurdles? What do you think we have to overcome? Is it like demand? Is it product market fit? Is it like a revenue case for everybody? Like, what is the thing that gets everybody to the better technology?
Demand is a big one. So go back to when we were talking about tokenizing real estate and other illiquid assets. The other wrong assumption back then was that tokenization was a supply side issue. That it was almost like, well, if as long as you tokenize it, someone will want it. But turned out, no. Like if people don't want to buy a house in Detroit, they wouldn't want to buy a token of a house in Detroit.
I think the market's actually smaller. There's probably like 15 bidders for that house in Detroit if you held the auction in Detroit. And if you said, to buy this house, you have to also have a crypto wallet and want the tokenized version of it, there might be 5 bidders.
Right. So I think that this demand side thing is really important. And again, like there's demand for dollars all over the world for doing different kind of things, including to use them in DeFi. Right? There's now demand for proxies for U.S. treasuries. I think there is demand for tokenized versions of the equity of blue chip tech companies and other kind of companies. But I think like identifying what that demand is important. And the demand has to come from someone who sees the value of not accessing that asset through the existing infrastructure. Which again, stablecoins like that. It's not people. My mother doesn't need a stablecoin living in America, but there are lots of people abroad, and I think it's interesting to go down the list and ask the question of okay, like if we're talking about things like equities, where might there be demand that is unmet today? Part of it could be it's people who can't. They want to invest in the Mag 7 but can't. Check. People who want to invest in the Mag 7 can through like U.S. brokerage accounts, but that has limitations that are problematic for them, like the ability to trade at 24/7. But there are also increasingly brokerages that are offering 24/7 trading, right? So it's like, okay, well, trade 24/7 and to be able to transfer it without having to sell it. So I think thinking about it from that perspective, and we have to continue to steel man the question like, okay, but is there a demand? Would someone want it? That is big. And then demand leads, right behind it has to be enough regulatory flexibility for institutions to get involved. That doesn't necessarily, like in an ideal world, we get genius, we get clarity, we get tax legislation, like because there's a bunch of stuff that these two don't address. I think that's unrealistic. However, it's even something as simple as a no action letter from a regulator or a sandbox from a regulator. That's that regulatory flexibility that allows issuers, because the market, to step up and say, I see the demand, I see the version of my assets that there's demand for, and I see that enough regulatory flexibility that no one's going to come knocking on my door if I do it.
Yep, totally agree. What's one thing that people don't understand about, blockchain as it relates to financial markets? This is a broad question, but, what do you think people, if they could attend one of your classes and learn, what's the number one thing people are missing?
Not all blockchains are created equal.
What do you mean by that?
So a token is just a wrapper. It's a container. I think the definition I use in my class is a arbitrary container of value, information, or rights whose provenance is tracked on a decentralized permissionless system. So if a group of, let's just hypothetically make up like 5 broker-dealers get together and they say, well, we've created a network and we're running some kind of a consensus mechanism and come tokenize on our platform. I think, first of all, I wouldn't even call that a token.
What is it, if not?
It's a database entry in a database that is owned by 5 broker-dealers, but literally there's one person who has access to a button that can turn it off, turn it on, kick one of the broker-dealers out.
Shared database.
It's a shared database. That has all the benefits of a shared database. It's fast, it's simple, doesn't need any of this complex cryptography, but also a lot of business and enterprise risks of a shared database. As opposed to if someone comes and says, well, I've issued a token on Ethereum or Solana, that asset has actually very specific property rights that you do not get on a shared database.
It's more tamper-proof than the asset that's issued on the shared database.
It's more tamper-proof. It's a lot more censorship resistant. It's possibly a lot more transparent. And it's they could both be easily programmable. You could have code that executes on a shared database, but the logic of the code is a lot more likely to execute exactly as the holder of the token anticipates it to on a public permissionless blockchain than on a database.
Right. It has better guarantees of how it works.
Yes.
Yeah.
Better guarantees. Ultimately, like, simpler way to frame all of this is that the best assets get the maximum property rights. And the nice thing about crypto and tokenization, if we're really like able to expand the surface area of the kind of property rights you can embed into the asset, but those property rights do not exist equally, even among blockchains, right? There's L1s, there's different kinds of L1s, there's L2s. And then when you get into like the permission shared database world, I actually think in some ways that's the worst of both worlds, because you don't have the crypto economic security principles and property right guarantees that you do in a novel permissionless system. But you also don't have the full legal regulatory protections that you do in the legacy TradFi stack. So it's almost like a dangerous kind of regulatory arbitrage that I am not a fan of, obviously.
Right. Well, in the legacy system right now, I mean, there's zero censorship resistance, right? In terms of your property rights, they're entirely enforced based on the regulatory structure and the legal structure, right?
Mm-hmm.
If I have my stocks in, a broker-dealer, like, that's enforced by law and regulators. That's not enforced by any code at all, right? Even if the code is broken, it doesn't really matter.
Right.
Because like the rights are the rights, right? And so where does that change as we start to move to a blockchain-based system? Because like clearly it becomes better property rights as you move to an on-chain system. But we're already starting off from a point where it's like, even if it's buggy, even if your assets get completely deleted, like they're still yours.
Yeah. So
how do we navigate that?
The permissionless system gives you the optionality of having a purely automated bearer instrument, right? For better or for worse. So the better is you get like maximum censorship resistance properties. So this is like sort of the thing that makes Bitcoin special is if you have Bitcoin, nobody could take it away from you or prevent you from spending it.
They can try.
They can try. But the infrastructure is designed to be robust against that. The downside is if you screw up, sorry, there's no one to call. If you get hacked, sorry, there's no one to call. But if you get, God forbid, kidnapped or something, sorry, there's nobody to call. Right? So I think what's special about permissionless systems is that they give you the optionality of exercising that. But you don't have to fully exercise it. Right? Like stablecoins, famously, I mean, this will be enshrined once Genius goes into effect. But the issuer does have these season freeze features. You could try calling them if something goes wrong. Now, they have to make a business decision as to whether they're going to do something about it or not. And that's a very interesting debate. So I think finding the right equilibrium on that spectrum, that's something that's going to require a lot of experimentation, like we were saying about how everything we know so far came from experimentation. I am probably an outlier in that I think we will, as time goes on, get closer and closer to that unrestricted bearer asset, even for things like the Class A shares of a S&P 100 company. Many smart people, some of whom are friends of mine, will vehemently disagree with this. And usually they'll use like, oh, but Apple will never tolerate North Korea being a shareholder. Because in the scenario that I describe, it's possible. Right?
Yeah.
I think I actually disagree, but we'll find out.
Do you disagree because when it comes to a corporate action, if North Korea is a shareholder, they just don't get a dividend. They can't vote their shares. Is it sort of enforced at the corporate level?
That's one option. It could
What
be
are the other options? Yeah.
The other option is that the company could say, I don't care, which there have been long periods in history where that has been the case. And you could argue, all else equal, the less a company cares who its shareholders are, the lower its cost of capital. And the companies that have a lower cost of capital, all else equal, tend to succeed more than the ones that have a high cost of capital. Now, we currently live in an era of abundant capital. So no one's really that worried about it, right? If anything, like the Apples of the world are more busy trying to figure out how to buy back more of their shares and issue new ones. But that could change. So I think that's one variable. But the other option is like the spectrum option is the company could say, and this is sort of the case with stablecoins, right? It's like, well, the terms of service say are these sanctioned entities cannot be our shareholders. We can't know exactly who any of our shareholders are. But if we suspect any of them are, we might do a check. Like, okay, you have to come in and do some kind of a identification in order to qualify for the dividend. Or they could even go as far as saying that we could void those shares. Whether they would want to do that or not remains to be seen.
Do you think there could be an in-between where, an issuer could elect for a model like that as an experiment, right? While the existing market structure of all equities doesn't change?
Yes. I think that's the more likely path for the foreseeable future. The more radical version of the capital markets that I think is possible will probably take a generation of people to come true, right? Like, this, even the painstaking process of reforming American capital markets after the paperwork crisis in the late 60s, early 70s, still took like 40 years, right? It's like, first we're going to dematerialize, we're going to keep the securities, but we're going to put them in a warehouse. And then later, like, all right, we're going to dematerialize, immobilize and dematerialize. These things take time. It's probably better to not take a move fast and break things attitude from a regulatory perspective. In America, we have 50 states that have their own property rights and corporate action rules. And then we have multiple federal regulators, and then there's every other country in the world. So it's going to be a long process of transformation, but I think it's important to try to stay in the front, not wait for like every question to be answered before you figure out how to deal with it.
Yeah. So in your mind, could there be some, like, I'm making a state up because there's 50, like some Wyoming corporation that conducts an IPO and goes public with like a bearer security on chain, and that's the model and we all learn from it.
Yeah. And don't discount the possibility of offshore jurisdictions using this as an opportunity to take regulatory and issuance market share. We've actually seen this throughout the history of capital markets, that whenever there's some kind of a change afoot, some jurisdictions see it as an opportunity. They say, American capital markets contemporaneously completely dominate the global stage. But if we're too slow to catch up with what this and other technologies, including things like AI, have to offer, you can bet other places, Europe, the Middle East, Asia, will say, okay, we will get in the forefront of that and use that as an opportunity to invite businesses to come raise capital here.
Yeah. I mean, that is an opportunity for a country to make itself the new home of capital formation.
Yeah. I think it will happen.
If you were the guess, name a country that you think has the best advantage.
Oh, I don't know. There's so many variables, and some of them are beyond my my domain of knowledge. I just know that it is, along with being the issuer of the reserve currency, part of our exorbitant privilege as America that our capital markets are by far the most robust, liquid, desirable in the world. We all benefit from it. Everyone, me, you, like every other random person.
This is like the jewel of capitalism.
Yeah. And our regulators benefit from this too, right? Like if you're going to be a financial market regulator, you want to regulate the NASDAQ and you want to regulate Apple. But that means that every other country out there, you can go from like London to parts of Europe to Dubai and Abu Dhabi to Singapore, maybe Hong Kong, maybe Japan, maybe these sort of like Caribbean island kind of locations like Bermuda that have had success doing things for markets like insurance or reinsurance or the hedge fund industry. I think they're all going to be trying. And I would advise America, as a proud patriot, we should not rest on our laurels here and say, well, we'll go at our own pace and like the world will wait for us.
Yeah. Right. I mean, if things move offshore, it's to the detriment of everybody in the capital markets today.
Yeah. And then it's to the offshore of our tax revenues. It's to the detriment of the US dollar. So the good news is right now we are in an environment in the US where it seems like everyone from members of Congress on both sides of the aisle to important state and federal regulators are sort of on board with the concept that it's time to evolve.
Yep. So let's do a thought experiment. All right. So in the existing status quo system, when you have an issuer, it's a company, it's about to go public, it's about to be publicly traded on one of the two major exchanges in the US. You have a lot of different intermediaries that make that possible, right?
Yes.
You have underwriters, you have, transfer agents, you have, broker dealers that are trading it, you have custodians, you have all of these different layers of the infrastructure around this very simple thing of a company is raising capital, it's now public, right? On the opposite end of the spectrum, you have this moves offshore into bearer tokens, and it's living entirely on a blockchain, and it's, Omid's, utopian/dystopian future, right? Let's talk about the middle here, which is things start to move on chain in the US somehow, maybe not like bearer capitalism, but the system evolves, right? Who do you see as the winners and losers of the existing architecture if tokenization starts to take root in the US? Like, which entities are better off because of this and which ones are worse off?
So I think underwriting is underwriting, and there's always going to be a need for underwriting. And the underwriters will have to evolve because underwriting a token might be fundamentally different, especially if it has it's not a full bearer asset, but it has some unique properties, right? Also with tokenization, you can completely change things like the pace of dividend issuance. You could do it daily if you wanted to.
You could do it by the block.
By the block, yeah.
Right.
And maybe that's...
And by the way, USTB calculates and distributes interest, by the second / by the block.
There you go. Because why not?
Why not?
Yeah.
Technology allows it. It'd be impossible,
yeah.
10 years ago, right? I mean, everything was built in business days, and now you have blockchains, and they're built in blocks.
Yeah. I did a whole paper with a friend who used to be a director general at the European Central Bank on this question of how much is the design of our financial products a slave to what the infrastructure can handle and how the modern technologies changes. And one of the questions I still have that one day will be answered by people far smarter than me. U.S. Treasuries, I believe, pay interest twice a year. That's probably a throwback to when they were literally a coupon bond.
Right. You literally, they're coupons because it was a sheet of paper.
Yeah.
And you literally ripped the sheet of paper off the bottom.
Yeah.
And you handed it to someone to get your coupon payment.
Right. And now it could be by the block.
Yeah.
So the question is for the U.S. government and investors in U.S. debt, what is the optimal remuneration cadence? I don't know. We'll find out because someday you could issue a token that does whatever you want. So going back to your original question, I think that's an interesting question for an underwriter to figure out, right?
Yeah. Is there more demand for something that has a daily coupon versus semi-annual?
Yeah. Or maybe it's possible that it turns out with dividend issuance, people don't care.
Right.
We'll see.
I think more is better. If you just use strategy and their preferred stock as an example, they're trying to move from monthly to semi-monthly.
Interesting. And on the derivative side, 0-day options are now something like 50% of the volume.
Well, that's because they're the most volatile gambling opportunity for speculators.
Yeah. But and I would not encourage anybody to touch them. Unless
but that's where the demand is.
That's where the demand is. The market has spoken.
Shortest term instrument possible. On Polymarket and stuff, they're doing 5-minute, prediction markets.
Yeah. We'll see where the equilibrium on all this is because there's also questions about fragmented liquidity and just noise being a problem with super short-term instruments. But going back to your other questions, there used to be this distinction in Wall Street between the buy side and the sell side. I think in general, tokenization, if I had to overtly simplify it, what was historically the buy side will be the big winner. And the sell side is going to be on the wrong side of a lot of this, particularly since, like I said earlier, my mental model of tokenization is it's only actually beneficial if you do it on decentralized, public, permissionless infrastructure. And the thing with the sell side is like what makes the sell side is really historically the sell side, which is the banks, the brokers, and their affiliates. They either own the infrastructure, literally, or they are the only gateway to get to the infrastructure. And this gives them enormous market power. Even in situations where it doesn't look like someone's making a lot of money, like the number of times I've had someone, I publicly said I'm skeptical of anything DTCC does because I think
I've seen that.
I think the future is not DTCC. It's really like, oh, it's a centralized securities depository. Well, that's what the blockchain does better. And people say, well, yeah, DTC doesn't make a lot of money. I'm like, right, but the participants in its clearing operations who also happen to own it make a lot of money. And I don't think that's a coincidence. You can say the same thing about Swift. So my mental model is in the long run, not everyone. It's not like the whole thing is going to go away and all the biggest banks and brokers will not exist. But they have an advantage today that is controlling access to the infrastructure. Tokenization means everybody has access to the infrastructure. It's going to be a lot harder for them to keep up as opposed to, say, the asset management industry. So I don't think it's a coincidence that you have players like BlackRock and Franklin Templeton that have been much more willing to do actual products, not POCs and experiments. And
right,
stuff.
Not press release products.
Not press release products. But of course, it's all become muddled between the buy side and the sell side. Like the big banks have huge asset management businesses. You have hedge funds that are major market making firms. So there's plenty of opportunity for all of them. And I think there will be some existing Wall Street organizations that do figure this out and turn it into a growth opportunity. But overall, if you are part of that capital market stack where it's like you're some company no one's ever heard of, you have 5 competitors, you've all been at it for 50 years, because you do some obscure thing like track who owns what shares or literally distribute the dollars for the dividends, I think they're going to have a hard time adapting.
Yeah, I think they will. We'll see though. We might be surprised by which participants actually, surprise us.
Yes, and I think there's opportunity for this. Probably just comes down to leadership, right? I think you're going to have some like CEOs and C-suites and boards of some companies that say, you know what, it's going to be hard. We have to cannibalize some of our existing businesses, but we got to do it. A direct quote I heard actually from the CEO of a company I'm not going to name, but I want to turn this into the kind of company my grandchildren would be proud of, because it was on the cutting edge of what's now possible. So there's going to be leadership that does that. And then there's going to be leadership that's very risk averse and will say, well, we'll wait until it's clear exactly what it is that we have to do. Then we'll start the process of transforming.
Right. Then we'll steer the entire cruise ship as fast as we can.
Yeah. It's not going to work because it takes years to get in front of this. It's hard. I mean, you would know better than me, right? It is hard to work in regulated environments. It's hard to evolve in regulated environments. It's very difficult to do things like issue an asset when you don't have pure regulatory certainty. So it's better to start now.
Well, that's why I think, crypto and tokenization is actually in a good place fundamentally, because it is hard, right? It's very hard to do things in a buttoned up, regulated way. But we also benefit from like so many things happening internationally in not buttoned up ways to like demo all of the different concepts, right? Like, we have so many different things happening in crypto outside of, the way we're doing it that everyone just watches and observes and learns from.
It's true. We even have things that we're talking about specifically asset tokenization, but there's a place in this conversation for something like a perp dex.
Of course. Oh yeah. I mean, like the whole spectrum of stuff.
The whole spectrum, yeah.
Perp dexes are amazing, right? Like, and I think at some point we'll have regulated perps in America, right? Because it's such a good product.
Yes. And then also throw into their prediction markets.
Great product.
Because there's a world in which you can own the equity of a company. You can go on a perp desk and perp DEX and just go long.
Yep.
Or you can participate in a prediction market that has a bet on something about the future of this company.
The earnings. If there's a company that's about to have earnings,
Yeah.
It might be a more pure thing to bet on whether the company's earnings are higher or lower than expected than try to buy the stock and hope that the market reaction is what you hoped for.
Yes. And this is to your point earlier. It's like stuff's being tried and the cat is out of the bag. So if people say like, oh, well, tokenization, I don't know if I want anybody to own the token. I'm like, well, anybody is going to be able to bet on it on a prediction market or via a perp dex, and they can get that price exposure. Now, you and I know that the rights, governance rights, property rights that one has is very different.
Yeah.
But there's a lot of situations where people don't care.
Well, here's one of the mismatches and why they don't care, right? Most companies nowadays don't pay dividends, right? And most people are not participating in the governance of the companies. Like corporate governance is a mess. And that's a whole different topic, right?
And on top of that, you have the companies like the newer tech companies where the corporate governance.
There is none. The founders have the Class B shares with 30x voting rights, and there is no governance, right? And so when you think about the core interactions that you have owning a company, for most people, it is truly just a purely economic engagement. There's nothing else to it. It's purely passive. It's purely economic. And some perp or a prediction market on it or whatever is just as good of a venue to get the economic exposure as being an actual shareholder.
Yes. I will say, though, that there are worst case scenarios with what could happen to your exposure.
Completely agree. There's so many different edge cases that all these products create.
Yeah. And I think it's like the optimal model is give the end investor and the issuer the menu. It's like, okay, if all you care about is you want to place a bet that in the next hour this stock's going to pop because of an earnings release, then the perp dex is good enough. If actually all you want to do is place a bet on whether earnings will beat expectations or not, and not what the stock will do afterwards, prediction market. If you're a Warren Buffett and you're like, I'm holding this thing for a decade. I just want the strongest property rights possible. I don't want to deal with 1010 ADL type of situation. About just derivative venues in general they have more systemic risk than a spot market because they allow leverage. And that's always going to be the case. And we can come up with great innovations. A lot like ADL is one, and insurance funds and all that. But at the end of the day, riskier than just owning the outright equity token. So I think what's great about the future is that issuers will decide where they want to focus. Investors will decide. And then the main thing is that there is disclosures and transparency. And this is where I think regulators will play an important role. So everybody kind of knows where they stand.
Yeah. Do you think the end state, just to go back to your utopian scenario, is the end state is we just have issuers and they choose for their stock to be a bearer asset in the AMM. And that's one of the product selections they can make?
Yes. But what they cannot then stop doing, as we see today, is they can't stop somebody from buying a bunch of it and then issuing an SPV model, different version of it. They'll never be able to stop someone from spinning up a prediction market about how the stock performs. Or the genius of the perp dex is all you need is a stablecoin, an oracle, and a trading engine, right? And away you go. So I think a lot of the concerns people have with we need to contain this tokenized equity or debt. It's you can't. It's literally impossible in this world that we're entering into.
Right. The cat's out of the bag in so many other places in so many other ways that, trying to restrain the token is, I think, incredibly noble, but there's way crazier things happening constantly everywhere, 24/7.
Yes. And it becomes a little bit like, how a lot of countries impose capital controls because they're scared of the capital leaving.
Yep.
But the strongest indicator or risk factor, one of them, of whether you should invest in a country in the first place is whether they have capital controls. Because you have to think, I can get my money in, but I'm not able to get it out. I feel like if there are issuers out there that try to play everything too close to the vest and like we want to control every aspect of this tokenized thing, the market will actually perceive it as some kind of a red flag. Say, oh, well, right now, you say you want to restrict ownership of your equity token to KYC accredited, yada, yada, yada. You're already imposing one restriction. How do I know if I buy these shares next year, you're not going to come back and impose a new restriction that harms me? Whereas if there are issuers that are like, here's my token, do what you will with it, it's possible investors will have more confidence.
Well, I can't wait to see the spectrum of different approaches and to see what starts to resonate with investors and regulators and, the existing financial infrastructure.
Same. I have the luxury of being just an outside observer who thinks and writes and opines on these things. You have a slightly tougher challenge of
right. I get to operate in the market.
You get to operate in the market on the cutting edge, and I think actually Superstate has done some very cool work so far. And I'm not just saying that because I'm here. I literally, long before you and I ever had any...
We brought you on the show regardless of your thoughts on Superstate.
Yes. But I do actually discuss what Superstate has done and a few other serious tokenization firms as like an indication of what the future will look like.
Appreciate that. Let's leave with one closing thought, right? About where you think capital markets are headed, how fast... and what you expect to see from, tokenization, blockchains, and the intersection with capitalism.
I think we're still looking at another couple of years of this being more of a trickle phenomenon. And it's possible that what really unleashes the wave of tokenization is not just, the technology is ready. It's not even like, Clarity Act is passed and now is in effect and rule making has done. It's possible that there are other variables in terms of macroeconomics or geopolitics that really accelerate adoption. Part of my broader mental model of the world is that things are headed in the wrong direction when it comes to trust in a lot of institutions and old ways of doing things. And crypto will be a net beneficiary of this once we get past the experimental stage, because it's just a fundamentally different model of building trust in a modern digital economy. So just as we've seen with things like Bitcoin adoption over the years, stablecoins, I think with tokenization too, it will ultimately be completely exogenous factors that sometime in the next 5 years will hit that takeoff ramp of adoption. And then it's just the question. Then there'll be no more people who are like, oh yeah, tokenization, that's interesting. It's like, okay, this is a race now. We better tokenize everything as quickly as we can.
Well, you heard it here. Tokenize everything as quickly as we can. Professor Omid, thank you.
Thanks for having me.